Chapter 22, we're going to be going through all this different stuff that's in the lecture guide. I'm going to try to move quickly through a lot of things, and then if at the end of the day you have some questions or something like that, again, just use the chat feature, and I'm going to do my best to pay attention to what's going on in the chat feature. Thank you, Lily. It's a little bit lagged, but we're getting there. All right, so here we go. Let's go some background first. And so when we talk about changes in error analysis, the first thing we're talking about is changes. And so when we have accounting changes, there are really three major types. The first one is that you could have a change in accounting principle. One example of that would be if a company is using LIFO and they decide to change to FIFO or back and forth. And so it's two acceptable accounting methods or principles, and they just change between one or the other. Other examples might be, for instance, when they had option accounting. There was a time where you could choose between the intrinsic value method and also the fair value method, and so you could switch between those two, and those would be changes in accounting principle. And there's others as well. Another type of change is a change in accounting estimate. So if you're depreciating an asset, something like extending the useful life or changing from double declining balance to straight line or something like that, those are changes in accounting estimates. So those aren't those are different than changes in accounting principles. Another change is a change in reporting entity. And so when we talk about change in reporting entity, that would be kind of like a reorganization. So you might be organized in geographic segments, and then change instead of geographic segments, you might instead be using business segments. You could also potentially go from 4 segments to 5 segments, or reorganize your company. And so those are other types of accounting changes. The other type of thing we're going to talk about in this chapter is accounting for errors. And so errors are intentional or unintentional misstatements of financial information, or it could be the misapplication of accounting rules. And so these are kind of bigger deals typically because somebody's done something wrong. Again, it could be intentional, it might be unintentional, but something has definitely gone wrong. And so those are usually a little more substantial to correct. All right, let's focus on changes in accounting principle first. There are several possible approaches when we talk about changes in accounting principle. One is called changing things or reporting changes currently. And so you basically have this cumulative effect. So let's say I change the way that I do my inventory accounting. Well, if I make that change, it's going to change cost of goods sold for however many years back, if you kind of think about it. And so there's a cumulative effect on income year over year over year. If you use this approach, basically you don't restate anything in a prior year, you don't change anything, you just kind of accumulate the effect on this year's income statement. And so if your income over the last 5 years would have been $20,000 more, you just have that as a additional item on your income statement in the current year. And so again, that's just one approach. A second approach is retrospectively, which basically means you sort of recast all your financial statements, acting as if the new principle were always in place. And so you're going to have restated financial statements, you're going to have adjustments to the earliest retained earnings presented, and this is a bigger change for sure, but it also gives you a lot more information, and so it allows you to really make year-over-year comparisons rather than having sort of one method in the prior year and a new method in the current year. So that's a lot different. And the last one is prospectively. Basically, you don't make any changes to balances, you don't have an adjustment to your income statement, nothing like that. You just basically say, okay, now we have this new system, and whatever happens from here happens from here. So you can see there's just 3 different ways that we can handle it. And so under US GAAP and under IFRS right now, we do make these changes retrospectively, which I do think provides the best and most complete information. And so anyway, so as we do this, we're going to be thinking about this retrospective change as we do an example.